Welcome back, friends. Today I'll be working through the accounting for non-monetary exchanges, both those with and without commercial substance. With that, let's get started.
Non-monetary exchanges. So Company A exchanged equipment used in its manufacturing operations plus $3,300 in cash for similar equipment used in the operations of Company B. So we have Company A and Company B. They're trading assets. Company A also gave up $3,300. The following information pertains to the exchange. So the equipment given up at cost was $30,800 for both companies. The accumulated depreciation on the equipment given up was $20,900 for Company A, but only $11,000 for Company B. So the book value of asset for Company B was much higher than for Company A. That is also reflected in the fair value of the piece of equipment given up. Company A's fair value was $13,750, and Company B's fair value was $1,750. Now, what I'm going to do before I dive into the journal entries, which we could do all of this via journal entry right off the bat, but I'm going to walk through some of the thought process before I go ahead and do that. So let's start with just figuring out the values being traded here. So the fair value of the equipment given up right here. Now, Company A is giving up that fair value piece of equipment plus $3,300, which totals $17,050. Not surprising, it equals the fair value of what's given up should equal the fair value of what you get. Otherwise, why would you do the transaction? So $17,050 is the fair value of this transaction. Now, we know the transaction's value is $1,750. So Company A, on the Company A's books, so we're just going to do, let's say, I'm just going to add in a line here. We're going to call this net book value. There, that's our book value. So the book value for Company A is $9,900. So they're giving up this book value plus the value of the cash. So they're giving up $13,200 to get something that's worth $1,750. Okay, so $1750. So if we took $1,750 minus $13,200, again, that was the total value of items, book value of items given by Company A was $13,200. So there's my little sum, $13,200. So the value of what we got minus book value of the items given up, they're getting $17,050. They're giving up stuff worth $13,200, which means they have a gain on disposal of $3,850. Now, so if we did it for Company B instead, value received is $1,750. The value of the items given up is going to be the book value of the stuff they're getting out, which is $1,900. So in this case, they actually have a loss. So Company A has a gain, Company B has a loss, and that's just the value of what's received minus book value of what they gave up is what's going to determine whether you have a gain or a loss. So there's our gain for Company A, loss for Company B. Now, if our transaction lacks commercial substance, we cannot actually do anything with this gain. You don't get to recognize a gain when it lacks commercial substance, especially since they are not receiving any cash. They are actually giving up cash. So Company A does not get to recognize this gain when they recognize their transaction. So let's record their transaction. And because it lacks commercial substance, we are not going to have a gain. So we're going to start with equipment. We're going to hold off on recording the amount of the equipment yet, because the gain we don't get to recognize has to now go against the cost of the equipment. So we're not going to be putting the equipment on the books for what we would expect, which is $1,750, which is the value of it. So it's not going to go on the books because it lacks commercial substance. So we're going to move on with the other stuff that we do know. So equipment. So we know what the accumulated depreciation is. Accumulated depreciation is $20,900. That needs to go away because we're getting rid of that piece of equipment. The equipment we're getting rid of, it's coming off of our books, and that's going to be the $30,800 is going away. We gave up cash of $3,300, and And that's it. There would be a gain right here, but we don't get to recognize that gain. So we have to figure out, well, what is the value of the equipment coming in? It would be $1,750, but we don't get to recognize the gain. So because of that, the value of the equipment coming in actually only going to be $13,200. Now, the $13,200 is just the book value of the items given up, right? And that's that is the amount that we carry. If it doesn't have commercial substance and we don't get to recognize the gain, the new equipment comes on at the same book value of what was given up in the transaction. Now, in this case, what was given up was both equipment and cash. It could have just been equipment and no cash at all. There was cash in this case. So that's how we determine that. Now, that should give us a balanced transaction. So our sum of debits is 34,100. Our sum of credits is 34,100. All we did was, instead of recognizing a gain, we reduced the value of the asset on the books. Now, when eventually we sell or use up this piece of equipment, basically the idea is like, well, right now it's being recorded at less than its value. Yep, exactly. So the costs going forward will be less than it would otherwise, which is fine because this transaction lacks commercial substance. So it's treating it very similar to like had the transaction never occurred is what it's basically doing here. So the book value stays the same. Now, that's for company A. For company B, we received cash of $3,300. We received equipment that's going to be worth $13,750. We have to get rid of our accumulated depreciation, which was $11,000. We have a loss on disposal. It's a loss, so it's a debit. So we have a loss on disposal of $2,750 that we calculated right over here. There's our loss on disposal. So we're recognizing our loss on disposal. And then we are actually we're giving up the old equipment, which has a purchase price of $30,800. So that should balance $30,800. It balances. Okay. Now, if the transaction instead has commercial substance, the only difference is all of this stuff stays the same. But now we get to, well, it doesn't all change. This is going to change. So I'll delete that. We also get to recognize a gain on disposal. The gain we get to recognize is $3,850. And we get to bring the new piece of equipment on at the full value of that equipment, which is $17,050. Now, we get to recognize this gain because we now have commercial substance. These guys, nothing changes. That transaction doesn't change. For company B, they never had a gain that they had to delay. They had a loss, which they had to recognize. So that transaction doesn't change whether it has or does not have commercial substance. So there is our non-monetary exchange with and without commercial substance.
So with that, have a great day and God bless.